Americans don't lose money because they're lazy. They lose money because the system is designed to drain them silently. Credit cards don't ruin lives overnight. They destroy Americans slowly, invisibly, legally. And the scariest part? Millions of Americans believe credit cards are helping them. This video isn't about blame. It's about truth. America's love affair with credit. America runs on credit. Over 80% of American adults have at least one credit card. Average American holds 3 for cards. Total US credit card debt trillions. But here's the question nobody asks. If credit cards are so helpful, why is America drowning in debt? Credit cards were not created to help consumers. They were created to generate profit for banks. And profit comes from debt. The profit paradox. The math is actually quite simple and a bit cynical. Banks don't make their real money from the person who pays their balance in full every month, often called deadbeats in industry slang, because they don't generate interest. The real profit comes from revolvers. The interest trap, with average rates often hovering between 20% and 30%. A $5,000 balance can double in just a few years if only minimum payments are made. Psychology of spending research consistently shows people spend significantly more when using plastic versus cash because the pain of payment is delayed. The frictionless economy, digital wallets, and buy now, pay later schemes have made it easier than ever to decouple the joy of buying from the reality of paying. The reality check. While it's true that cards offer rewards, fraud protection, and credit building, those perks are refunded by the interest and fees paid by the millions who are struggling. It's a wealth transfer from the struggling to the savvy and, of course, to the banks. A grounded perspective: credit cards are like power tools. In the hands of a pro, they build a house. Credit score, rewards, in the hands of someone who hasn't been trained, they can cause a lot of damage very quickly. Why is America drowning? It isn't just about spending too much on lats. There are systemic factors at play. Wage stagnation. For many, credit has become a way to bridge the gap between flat wages and the rising cost of living: healthcare, education, housing. Financial literacy gap. Most Americans are never taught how I equals sign P times R times T. Interest equals sign principal rate time actually works against them in a compounding environment. The score obsession. We are conditioned to believe a high credit score is the ultimate sign of financial health, which encourages keeping lines of credit open and active. The invisible tax: merchant fees. Even if you are a deadbeat, someone who pays their balance in full, the credit system still takes a cut. Every time you swipe, merchants pay a fee, usually 1.5% to 3.5%. The result: businesses raise their prices to cover these fees. The squeeze: this means people paying with cash are effectively subsidizing the cashback and travel points of credit card users. It's a systemic inflation that makes everything more expensive for everyone. The psychology of mental accounting. Banks invest billions into behavioral economics to ensure you keep swiping. Here is how they hack the human brain. Gamification: points, gold status, and leveling up. Card tiers turn spending into a game. We feel like we're winning a free flight, even if we spent $10,000 to get it. The minimum payment illusion. By setting the minimum payment extremely low, often just 1% of the balance plus interest, banks anchor your brain to a small number. It makes a $5,000 debt feel like a $1.50 a month subscription rather than a massive financial burden. Abstract currency: swiping a card or tapping a phone doesn't feel like losing money. It lacks the tactile feedback of physical cash leaving your wallet, which removes the emotional sting of spending. The economic catch-22. America is in a position where it cannot easily quit credit. The U.S. economy is driven roughly 70% by consumer spending. If Americans stopped using credit tomorrow, spending would crater. If spending craters, the GDP shrinks, leading to a recession. Therefore, the system is incentivized to keep you borrowing to keep the engine running. The math of the death spiral. To put the drowning. The biggest credit card lie. The lie. Just pay the minimum. Minimum payment sounds harmless. But here's the trap. Minimum payment equals interest first. Your balance barely moves. Debt becomes permanent. Example. You owe $5,000. AAPR 24%. Minimum payment till $150. You'll pay for years, you'll pay thousands extra. One missed payment equals penalties. Banks love minimum payments because they turn borrowers into lifetime customers. Interest legal theft. Interest isn't just high, it's brutal. Credit card apes are 18%, 22%, 29%, sometimes over 30%. That's higher than student loans, auto loans, mortgages. Why? Because credit cards are unsecured and banks shift risk onto you. Miss a payment, interest spikes, fees added, credit score damaged. It's a one-way street. The anatomy of the interest trap. The unsecured premium since there's no asset to seize. Banks charge a risk premium. You aren't just paying for your money. You're subsidizing the cost of everyone else who defaulted on their cards. Daily compounding. Most cards don't just charge interest monthly. They calculate your average daily balance. Every day you carry a balance, the interest itself starts accruing interest. The penalty pivot once you miss a payment. Many TNCs allow the bank to trigger a penalty AAPR, which can jump to 29.9% or higher, regardless of what your introductory rate was. The math of the damage. If you have a $5,000 balance at 29% APR and only make the minimum payments, it could take you over 20 years to pay it off. You would end up paying back roughly $15,000 to $20,000 total. The bank effectively sells you your own $5,000 for 4x the price. The reality check. The only way to win this game is to treat the credit card like a debit card. If you can't pay the statement in full every month, the bank isn't providing a service, they're harvesting your future income. It's an uphill battle, but there are ways to theft-proof your finances, like debt snowballs or 0% balance transfer maneuvers. The minimum payment illusion. The minimum payment isn't designed to help you clear debt. It's designed to keep you current while maximizing the interest window. The math. Most minimum payments are calculated as interest plus 1% of the principal. The result, you are essentially just treading water. You pay off the interest you accrued that month and a tiny sliver of the actual debt. This ensures the average daily balance stays high for the next month's calculation. 2. The grace period trap. Most people don't realize that the 21-day grace period only exists if you pay your balance in full. The moment you carry even 1.00 over to the next month, the grace period evaporates. New purchases start accruing interest the second you swipe the card. There is no interest-free month anymore until you bring the balance back to zero and hold it there for a full cycle. 3. The psychology of available credit. Banks don't just give you a limit based on what you can afford. They give it based on your ceiling for paying. High credit limits entice lifestyle creep. By keeping your utilization ratio high, your credit score might actually dip, preventing you from qualifying for lower interest personal loans that would help you escape the credit card debt. It's a self-reinforcing loop. 4. Why the rates are climbing even more. Credit card apes are usually pegged to the prime rate. If the central bank raises rates to fight inflation, your credit card interest goes up automatically. Unlike a fixed-rate mortgage, your legal theft gets more expensive without you ever signing a new contract. Rewards. The sweet poison. Cashback, points, miles. Sounds great, right? But here's the truth. You don't earn rewards. You pay for them. Banks calculate how much more you'll spend, how often you'll carry balance, how long you'll stay in debt. Rewards are psychological bait. Studies show people spend 12–18% more using credit cards. Pain of spending disappears. Swiping feels painless. Rewards aren't free. They're funded by your interest, merchant fees, late penalties. The credit score trap. America teaches this. A good credit score means financial success. Reality, a good credit score means you're good at borrowing. To build score, you must use credit, carry balances, make consistent payments. So the system forces you to stay in debt, stay dependent, stay inside the system, pay everything in cash. Ironically, your score suffers. Is it a trap or a tool? Whether the system is a trap depends entirely on your strategy. Here is the direct truth about how to navigate it without staying dependent. The carry a balance myth. You actually do not need to carry a balance or pay a cent in interest to have a perfect score. Paying in full every month still reports on-time payments. If you're paying interest just to boost a score, you're losing money to buy a badge. The cash penalty. You're right. If you opt out of the system entirely, you become credit invisible. This doesn't matter if you're buying groceries, but it becomes a massive hurdle if you want to rent an apartment, get lower insurance premiums, or buy a home without a 100% cash down payment. The middle path. Many use credit cards like debit cards, spending only what they have and automating the full payoff. This builds the score, the tool, without falling into the debt, the trap. The reality check. The system isn't designed to make you wealthy. It's designed to make you predictable. For the banks, a person with $1 million in cash and no credit history is a risk because they have no data on how that person treats a lender's money. It's illogical, but it's the infrastructure we're currently stuck with. Emergency lifetime debt. Most Americans don't use credit cards for luxury. They use them for medical bills, car repairs, groceries, rent gaps. One emergency, one swipe. That's all it takes. What starts as $800 becomes $3,000, then $7,000, then unpayable. Because interest never sleeps. To understand how an $800 emergency turns into $7,000 of debt, we have to look at the mechanics of compound interest and minimum payments. When you carry a balance on a credit card, the bank charges you interest every month. If you only pay the minimum, usually just enough to cover interest plus a tiny bit of the principal, the remaining debt stays high. The next month, they charge interest on that new, slightly smaller balance, and the cycle repeats. Let's break down the two main forces that create this lifetime debt. 1. The power of the AAPR. Credit cards often have an annual percentage rate. AAP are between 20% and 30%. Because this interest compounds daily, the amount you owe grows even when you aren't spending a dime. 2. The minimum payment trap. Banks design minimum payments to keep you in debt for as long as possible. Often 90% of your payment goes toward interest, while only 10% actually reduces what you borrowed. Visualizing the math, we can run a hypothetical scenario to see exactly how many years it takes to pay off $800 using only minimum payments. The snowball versus avalanche. We can explore the two most popular strategies people use to pay down debt quickly. Interest rates and credit scores. We can discuss how your credit score determines your interest rate and why that matters for your wallet. The math of interest. We can look at how a single $800 emergency charge grows over time using compound interest, so you can see exactly how the numbers shift. Strategies for the spiral. We can discuss common methods people use to break the cycle, such as the debt snowball versus debt avalanche, or the role of AAP, our annual percentage rate. The credit ecosystem, we can explore why interest rates are set the way they are and the impact this has on the broader economy and personal credit scores. Paycheck to paycheck cycle. Over 60% of Americans live paycheck to paycheck. Credit cards become temporary relief, false safety net, silent chain. People don't feel broke until the statement arrives. Debt creates stress. Stress leads to bad decisions. Bad decisions create more debt. This is not an accident. This is design. Late fees and penalties. Missed payment? Here's what happens. Late fee $30, $40. APR increase. Credit score drop. Penalty FID APR up to 35%. One mistake equals 9 months of damage. Banks call this risk management. Consumers feel it as punishment. Why banks want you broke but paying? Banks don't want you bankrupt. They want you always paying, never finishing, slightly struggling. The perfect customer carries balance, pays minimum, misses occasionally, never escapes. That customer is worth tens of thousands over a lifetime. The anatomy of the perfect customer. Banks use sophisticated data to identify the most profitable behaviors. Here is why those specific traits are so valuable to them. The minimum payment loop by setting minimum payments at roughly to 3% of the balance. They ensure you're mostly paying off interest while the principal barely budges. The revolver status in the industry. People who pay in full every month are called deadbeats because they use the bank's money for free. People who carry a balance are revolvers, the true profit engines. Strategic friction, making it easy to spend, but slightly annoying to set up. Aggressive autopay or principal-only payments is a feature, not a bug. The fee cascade. A missed payment doesn't just result in a late fee. It often triggers a penalty APR, hiking your interest rate from 18% to nearly 30%, making the debt even harder to escape. How to flip the script. If the bank wants you slightly struggling, the best way to win is to be the customer they actually hate. Become a deadbeat. Pay your statement balance in full every single month. Use their rewards points and pay $0 in interest. The snowball avalanche method. If you're already in the loop, pick a strategy to kill the principal. Don't just pay what you can. Have a mathematical plan. Automate above the minimum. Even an extra $50 a month toward the principal can shave years off a long-term loan. Credit cards and mental health. Debt doesn't just drain money. It drains peace, confidence, sleep. Studies link credit card debt to anxiety, depression, relationship conflict, reduced productivity. Money stress becomes life stress. The biology of financial stress. We can look at how chronic debt triggers the body's fight or flight response, affecting sleep and cognitive function. Psychological strategies for debt management. We can discuss mental frameworks, like the snowball method, that focus on psychological wins to build confidence and momentum. Societal impacts and relationships. We can explore why debt is such a frequent source of conflict in relationships and how to navigate those tough conversations. Credit card debt is unique because of its high interest rates and the revolving nature of the balance, which can create a feeling of being trapped in a cycle. This constant pressure triggers the body's stress response system, leading to the drain on peace and sleep you mentioned. To help us dive deeper, which of these areas should we examine first? The psychology of high-interest debt. We can look at why credit card debt feels more stressful than other types of loans like a mortgage and how it affects our decision-making. Physiological effects of financial stress. We can explore how chronic money worries impact the brain's ability to focus, solve problems, and regulate emotions. The debt mental health feedback loop. Who benefits most? Not you. Beneficiaries. Major banks, payment processors, financial institutions, Shareholders. Every swipe feeds the machine. How Americans can escape real solutions. This is not anti-credit propaganda. This is awareness. Smart rules never carry balance. Treat credit like cash. Emergency fund credit limit. Fewer cards equals more control. Pay full statement monthly. Credit cards should be a tool, not a lifestyle. Credit cards don't destroy Americans loudly. They destroy them quietly and monthly legally. The moment you understand the system loses power over you. Debt is not normal. Struggle is not failure. Awareness is freedom. If this video opened your eyes, share it with one person who needs to see it. Subscribe for real financial truth.